Hey everybody, it's Brian Shannon from AlphaTrends.net. It's Friday, the 24th of June, 2016. Hopefully you didn't have a horrible day today, but obviously a lot of people did if you were long equities. The S&P is now negative year to date, as of course the NASDAQ has been, and Russell's negative year to date again, and those biotechs continue to just get smashed down 11% this month and 6% year to date. I'm not going to focus on what a lot of other people focus on, which are stats and statistics about how bad today was. Instead, we're going to do what we always do, which is to focus on price action and try to make sense of where it's come from and where it has the potential to go. So today, obviously, was the big day this week. We had the news out of Europe, and for the week coming into today, it looked like the buyers had some kind of information that they thought was correct, and this is what I just drawn in there was the volume-weighted average price for the week. So we gapped up, of course, on Monday, and then a lot of chopping back and forth. Yesterday we went out at those highs, and of course those people got trapped. Today's gap lower came down to the year-to-date low, and I'm sorry, to the unchanged level for the year, basically, and that's from where we got that bounce initially. And from there, of course, what we had seen was that the sellers had taken back control throughout the session. And as I posted in my midday video to subscribers, that right around in this area is when I did that. I said, I expect this market to go out near the lows for the day. And that's exactly what we had. So there was great opportunity for shorting in the afternoon if you didn't get involved in that initial dip. I think the psychology of this market is changing. That is, the dip buyers are going to be punished here. We have to look at all potential scenarios. So let's start with facts. We are down for the year, only by a small fraction, but we're well off the lows. And from the February low right here, here's the volume weighted average price from that low. We also came and undercut this low from last month, and this has been an important level as far as some consolidation this year. Looking back a little bit further, we can see that just below us we have the 150 and the 200-day moving averages, the 150-day being that green one and the black one being the 200-day moving average. So it seems as though we're into an area which should act as support. However, let's let the market decide, and again, focus on price action. So the bounce came right up to this prior band of support, and that's where it fell apart. Going into next week, I think that we have to look at rally attempts as guilty till proven innocent. We are below a declining 5-day moving average. Any trades here on the long side from this point should be considered day trades unless the market can somehow get back up above 208 early next week. If it can do that, then I think things will have mitigated, but there's zero evidence of that, especially with the weakness of today's close. So going into next week, yes, we're at a potential level of support. So, selling short right here after this decline doesn't necessarily make a whole lot of sense. But if we get rallies up to what will be a 2-day volume weighted average price on Monday, so up towards this 204.75 to 205 level, I would be looking for a failure in that area. If it doesn't fail, then you don't short it. But if it starts to roll back over, that's when you get short. And that's what I talk about each and every day in these videos for subscribers, during a midday video and during the chat room, and of course with the end of day updates. The NASDAQ, again, this chart looks like a mess. I'll show you why. Here's what I was talking about yesterday with subscribers, that we had this symmetrical triangle building, and that I thought that it was good that we had a nice cushion below us. It seemed that maybe it would come down to this trend line. Obviously, it went down to the next level of significance, and that level of significance is important for a couple reasons. So let's just clear this off, and I will show you why this is a level of significance. A level of significance shouldn't be confused with a level that you need to buy at. It's a level where we want want to look at the market action more carefully for evidence that the buyers are actually gaining control. Right now, we don't have that evidence. We have the year-to-date volume-weighted average price that we've closed below today, and we have this prior important area of support and resistance. So it had been resistance earlier in the year, and then as it broke it, it tested it as support. It tested it as support again, and then held. Now we're closing at the bottom end of that range and backing it up to a weekly time frame. We can see here on this weekly chart that things are looking pretty dire here. I don't want to say I think it's going to cave in from here, but certainly the path of least resistance is lower, and it's time to be super cautious. If you're going to buy bounces, expect that it's highly likely they will find resistance, and that resistance, it doesn't mean, so if you buy in here and let's say you get lucky and it opens up near this level, maybe it continues to move higher. That's certainly a possibility. I'm interested in possibilities, but probabilities are more interesting to me. This is more likely if we're to get back up into that area. The initial bounce didn't last nearly as long in the NASDAQ, and this market, of course, did go out on its lows, and as I mentioned, down below the year-to-date volume-weighted average price. So basically what that means is the average participant is now losing money in the NASDAQ this year. And when we back it up further, we can see that that goes on even to last year's lows. We're below the volume-weighted average price from that event. We're below the volume-weighted average price from the recent low last month. So there are a lot of people losing money in the NASDAQ right now, meaning that's potential for likely overhead supply. Overhead supply meaning if we get rallies, people are going to be maybe frustrated with the market and thinking, now I can get out even. So the path of least resistance is lower. We've come down fast and hard, but maybe we're going to continue lower. It is guilty till proven innocent, and it's going to take a lot to change these trends. So be careful. Be willing to change your mind as the market tells you to, and know the time frame that you're trading on. If you're a short to intermediate term trader, I think that Alpha Trends is the right place for you to look at as far as a subscription goes. The Russell 2000, here's our year-to-date. That is the year-to-date price level. That is where we had closed in last year, and you can see we closed below that once again. The 50-day moving average is still rising here, and this market has been really the stronger, bigger index over the last couple weeks. And when we look though at the shorter-term time frames, yesterday it was a trap in front of a big news event. So as I told people, this is we have a higher high above a rising 5-day moving average yesterday, but is the risk worth the reward for your risk tolerance with a big event coming? And a lot of people got burned if they answered yes to that question. But the point is not to talk about what could have happened, but instead what's likely to happen from here. I think that this is the likely area of resistance if we get some bounce in here on Monday and Tuesday of next week. But overall, I think you have to look at these markets as these are big events in here that are occurring, and it's going to be very technically driven. It's going to be very emotional, and if you're not good at looking at the markets technically, it could be very costly to be involved in these markets. The semiconductors, this has been absolutely the strongest group. They were closing in on the all-time highs at yesterday's close, and we can go to the monthly time frame and see that that's the all-time highs over there that we had seen last year. And now we've seen a giant reversal. You've heard the phrase, from failed moves come fast moves. Well, we saw a fast move lower. I threw some key volume-weighted average price levels in this semiconductors as well. So from this low, the volume-weighted average price, we undercut that. From the lows in February, we're still above that, and maybe we drift down towards that level. But the fact is, rather than focusing on where the support might be, of course, we want to know that. Focus on what is happening in the time frame that you're involved. When the markets are below volume weighted average price levels for the day, do not expect that a buy is going to make you money. That is one of the basic principles that I drill into subscribers every single day, that we don't want to buy while the market is below a declining volume weighted average price. And flip side, we don't want to short while it's above it. Wait for it to break back down, show a lower low, and then get short. But right now, the semiconductors obviously, again, have had a big decline in here. They're at a prior important level, and it seems as though maybe, before this market catches some support, I think it's more likely to drop down through that advancing 50-day moving average. And the biotechs continue to be garbage as well. This group on Thursday, I was telling subscribers that we'll want to start keeping an eye on this level up in here, that it's come down really sharply here the last couple weeks actually, and that it was starting to show signs of potential stability. We still had a declining 5-day moving average. What we were looking for was a higher high above that 5-day moving average, and to look at it as when we have the declining 5-day moving average, it's guilty till proven innocent. As it starts to turn sideways, we look at the potential for a turn. We don't buy thinking it is a turn, but we look for the potential. Just like on the long side, we look at it and say higher highs and higher lows above a rising 5-day moving average. It's dumb to sell short for anything other than a day trade. Over here, as it breaks back down and lower highs and lower lows below a declining 5-day moving average, that's where you want to be short. As it starts to turn sideways, it looks like it's time to cover shorts and maybe think about going long, but instead this morning, obviously, the bottom fell out in this group as well. They are in an area that has been support this year. That doesn't mean it will continue to be support. The more time support is tested, the more likely it is to fail to hold up. So this could be just a pause within a downtrend, and resumption comes below here. Back over to Apple. We talked about this one last week as a potential short candidate for this week, as it was below the volume weighted average price from the shakeout lows that we had seen last month. And that volume weighted average price was taken out last week, and we stayed below it. And we are also, of course, below a declining 5-day moving average. It got back above that 5-day moving average, but the 5-day moving average was still declining, so guilty till proven innocent. And here we are with a stock that's in a downtrend. Don't be confused about what you think a good company is. It's a garbage stock. Hope everyone had a good week, and rest up this weekend for a should be volatile week next week. Thanks for tuning in.